we start our meeting now. Mr. Rwaiswa from Uganda. You are the new participant. Please do some introduction.
You can hear me now?
Yeah. We hear you.
Yeah. I was saying that my name is Ronald Rwaiswa.
Okay.
I work with the Microfinance Support Center here in Uganda, Kampala. Microfinance Support Center is a government of Uganda entity. Is owned by the government 100%. And I am in the role of zonal manager. I'm in charge of West Nile. West Nile borders Congo, Southern Sudan, and I'm in charge of business growth and provision of business development services. The Microfinance Support Center focuses on microfinance institutions. We are a wholesale lender, so we focus on groups, circles, and microfinance institutions. So this course is so prudent. It resonates and solidifies my passion for growth in the microfinance sector, that I'm a better professional in the sector to be able to use the best practices that I am eager to learn from today. Thank you very much. I am here.
Thank you. Thank you, Mr. Ronald. Thank you very much. And Mr. Abdul Karim, what was your previous week as concern of learning? I shared the material with you guys in this course, and you got good marks in first assessment test. Mr. Abdul
thank you, sir. Thank you, sir. In last session, we have learned how some countries are working on it. Overall, we have covered all things about micro.
Okay. Thank you. And Mr. Ronald, you attempt the first MCQs test. What was your experience out?
I have so far done 2 tests. The first one was on the ratios and to pick up concepts used in microfinance. It was a good experience. I scored, I think, 83, and it was a good mark. So it also opened up on the gaps where I was not able to have the knowledge. So it took me back and I was able to understand more concepts. Then the second one that I did today, it was a good one. It was still on the microfinance and financial inclusion. I took that even citing examples from our neighbors here in Kenya who have successfully implemented the M-Pesa as part of the financial inclusion strategies that reach out to the unbankable. I appreciate it. Thank you.
Okay, thank you very much. So we start the intro of our learning about upcoming week. First of all, we make a short review of the first week, which titled as Introduction to Microfinance and Financial Inclusion. In our first week, we laid the foundation for microfinance and financial inclusion, covering essential concepts, their impact on economic development. I will note some points which we discuss in this first week module: understanding microfinance, definition, scope, and how it empower low income individuals through microloans, micro savings, and micro insurance. The role of financial inclusion, how digital banking and FinTech innovation are helping bridge the financial gap, especially in developing countries. Evolution from traditional banking to digital microfinance. The shift from manual banking system to AI-driven mobile-based microfinance solutions. So we discuss a case study of M-Pesa, the first ever mobile-based bank app, which cover the financial inclusion as microfinance banks covered through their rural or urban network. That's called M-Pesa. How M-Pesa transformed financial access in Kenya, providing a secure and cashless financial ecosystem. So now we are in this session, we are discussing our second week module. It's about have three parts on consist of three modules. The first is the fundamental. The topic of this week is the fundamentals of microfinance and lending at the micro level. Microfinance play a crucial role in providing financial access to underserved communities, empowering low-income individuals, small businesses, and marginalized population with essential financial services. This section explores the key microfinance models, financial products, risk assessment strategies, and practices in managing microfinance institutions, MFI and MFIs. So it's our second week learning, and we have what three part. We discussing here the three part for our learning and we will assess the participant on these modules. And number one is microfinance. Microfinance models, group lending, individual lending, and hybrid models. Microfinance institution MFIs use different lending models to provide loans to individuals who lack access to traditional banking. These models offer in loan structure, repayment responsibility, and risk assessment. Group lending model, it's a very famous model, and when the microfinancing start from different part of the world, and the Grameen Bank in 70s era, its first lending model is the group lending model. In group lending model, borrowers from self-selected group and loans are provided to individual within the group. However, the entire group is collectively responsible for loan repayment. Key features: social collateral, high repayment rates. In this model, the repayment rates are oftenly high. Example, ideal for small businesses, honors the rural entrepreneurs and women-led enterprises. We have an example of Grameen Bank, Bangladesh, pioneered group lending, offering a small loans to women entrepreneur, lending to higher financial independence. Individual lending model. In individual lending, loans are granted to single borrower who is solely responsible for repayments. The key feature of individual lending is require credit history assessment or financial background, sustainable for larger loans and longer repayment periods, used in urban microfinance program for small businesses owners and traders. The example, microfinance banks in India and Latin America often the individual lending for urban enterprises who need higher loan amount. Hybrid model, the third model is called hybrid model, a combination of both group and individual lending, offering flexibility in loan structures, key features. Borrowers start in group lending, then transition to individual loans after building a strong repayment record. We call them graduation. Provide an alternative for experienced micro entrepreneurs seeking larger loan amount. We have an example of Kia and SKS Microfinance in India provide hybrid models helping borrowers granted from group to individual lending in Pakistan. Also, NRSP Bank start from group lending and gradually graduate his clients to individual models. Okay, the microcredit and micro loans. Small loans for businesses expansion, agriculture, and personal emergencies, usually unsecured loans, no collateral required. Loan size range for $50 from in PKR around about 30,000 PKR or 30K PKR and to 300,000 PKR with flexible repayment terms. An example, Block Microfinance provides small loans for women-led businesses to support sustainable entrepreneurship. The Block Bank is situated in Bangladesh. Micro saving. A low-income individual can deposit small amount, building financial discipline. Saving accounts have low or minimum balance required. Help borrowers avoid resilience on high interest loans during the financial crisis. For example, Airtel Money and Jazz Cash offering digital micro saving in Africa and South Asia. Micro insurance. These are three main pillars of micro financing: micro credit, micro saving, and third one is the micro saving. Micro saving provide affordable insurance against health, life, agriculture, and asset losses. Reduce financial vulnerability during natural disasters, illness, and economic shocks. Premium are low cost and collected digitally via mobile money. For example, Clemo Salma, Kenya provides weather-based crop insurance for farmers, protecting them against droughts and floods. Micro leasing. The fourth pillar is the micro leasing. Allow borrower to lease equipment or machinery for business use. Payment for structured in installments, lending in eventual ownership. Used for agricultural tools, sewing machines, and transport vehicles. For example, micro leasing program in Nigeria and Uganda help farmers acquire tractors, enable higher crop yield. So Mr. Rwaiswa, you may have any example from Uganda, from these four pillars we discuss for micro financing. Mr. Arnold, your voice is very slow. Voice is very slow. Okay, I think there's a network problem. Can you listen me?
Yes, I can hear you, sir.
Okay, you can hear. Thank you. So, interest rate, risk assessment, and credit scoring in microfinance. Microfinance institutions must balance financial sustainability with affordability, ensuring loans are accessible while minimizing risk. Interest rate in microfinance. Unlike commercial banks, microfinance loans vary higher interest rate due to higher operational cost and small loan size. Rates are vary between 15% to 40% annually, depending on borrower risk, loan size, and repayment period. Example: Sol Bolivia offer competitive microloans interest rate tailored to borrower profiles. Number two, risk assessment in microfinance. Microfinance lenders evaluate borrowers based on income stability. Does the borrower have a consistent revenue stream? Number two, repayment history. Has the borrower repaid the past loan on time? Number three, business viability. Is the micro enterprise profitable? Example: microfinance program in Philippines assess credit risk by analyzing borrower cash flow and business operations. Number three, AI-based credit scoring and alternative data. Use mobile phone using usage, utility payments, and loan behavior to assess credit worthiness. All AI-driven lenders like Tala Branch, Africa, and India provide loan based on mobile transaction history. Example: credit access to first-time borrowers who no formal credit history. They provide the borrowers are larger, even a larger loan to see the transaction history from his mobile account. Example: FinTech lender in India, Kenya use AI to offering instant microloans without requiring collateral. Best practices for managing microfinance institution MFIs. Number one, financial sustainability, digital transformation, customer-centric approach. And our third module for upcoming week is the role of the FinTech in financial inclusion. How FinTech expand microfinance access, mobile banking, and digital wallets, M-Pesa, Paytm, Jazz Cash, Easy Pesa, AI-powered credit assessment, blockchain-based lending, and smart contracts. The impact: reduce cash dependency, enable instant payments, microloans, and saving. Example: M-Pesa has lifted 2 million Kenyans out of poverty. The future of digital microfinance: AI-powered financial coaching, biometric authentication for microloans, cross-border digital payment for microfinance borrowers. Example: ANT Group in China use AI-driven lending wealth management tools for small businesses. So this is our the module of upcoming week, and we will provide you the detailed booklet about the material, a specialized booklet. It's a brief intro of this module that we will learn in next week. Any question from you guys about this? Mr. Abdul Karim? Mr. Arnold. Okay. Mr. Arnold, do you want to say?
It's clear, sir. It's clear. No
Mr.
question.
Abdul Karim? Okay. Mr. Abdul Karim, please.
Yes, sir. I have got it. What you are telling. I think it's clear. And further detail we will discuss in upcoming week. So thank you so much.
Okay. Thank you, Mr. Abdul Karim. And Mr. Arnold?
So what you have defined already what we want to require more improvement, the way we are going to see in the
Mr. Arnold, I think
So-
you have the net problem and we can't hear you clearly. So we don't have enough participants. We cut short our this Zoom session here. We make the thank you all of you to join this session. We will provide you the detailed material about this upcoming week and take the assessment test on upcoming Saturday.